one of the things that I am trying to avoid is to talk about other mortgage companies, because from what I've also come to notice, especially buying new construction homes, is they will convince you to go with their in-house mortgage companies. And they tell you about all the fees, all the credits and programs that they have, but they don't tell you that you're also going to pay for the cost of the street in front of your house and in that community, right? Thank you for joining us again, Rich. We did talk a little bit about mortgage types on a previous episode. On this episode, I guess we are going to look at a few things right before you sign the documents or on the closing date, some of the things you need to be looking at. And also, after you've purchased your home, you still need to understand your mortgage and some of the things that come with it, because it is a huge investment, which also comes with a huge responsibility. So thank you again, Rich, for joining us to share more of your knowledge and experience with us.
I appreciate that. Thank you very much, Patrick, for having me. My name is Rich Kimball with Cross Country Mortgage. Been here now officially this month, 13 years with Cross Country, and in the mortgage space for over 30 years.
Nice.
Originated over $1 billion worth of mortgages over my career, and still love it. I just want to do this until I retire, and I may not retire. We'll see, Patrick.
Thank you, Rich. Let's dive straight into it. Now, there are two things I want us to talk about, and I guess on the previous episode, we did talk about one of them, which happens to be escrow. You did mention it. I didn't really wanted to dive into that because I knew we were going to talk about escrow, and also interest rate.
Sure.
A lot of people have a misconception about interest rate. What determines an individual's interest rate? And let me provide a little context on that. I've heard some clients say, oh, I want to shop for different mortgage companies to see who can give me a lower interest rate. In my mind, I think it's a waste of time sometimes, because it's going to depend on their financial profile. That is my basic knowledge. So what is interest rate? What determines an individual's interest rate? And then maybe we can transition into an escrow.
Excellent. Thank you, Patrick. So first of all, shopping, I'm not against somebody shopping as far as that's concerned. Just do it early on and make your decision early on. We do provide an interest rate guarantee, which basically says, hey, look, if you happen to find something cheaper, bring it to us. We'll take a look at it. May have to go to our corporate office in Cleveland to see what we can do about matching it. We'd love to retain the business. There's that. But I want to talk about shopping in general then, because how it's done is really intriguing to me. If you went into your doctor, Patrick, and you said, hey, I'm short of breath, what can you prescribe me? That's not enough information. And it's not enough information for him he or she to prescribe you anything, because we don't know why you're short of breath, how long you've been short of breath, what other symptoms are coming with that. What does short of breath even mean to you? Are you able to walk across the room, or you can't even get out of your chair? So I look at getting an interest rate quote also as getting a diagnosis, because ultimately what goes into an interest rate quote depends a lot on what's going on with the borrower. So there's really three major things that we talk about. Credit score has a lot to do, because it'll tell me what type of loan that I can get you. Also, the type of property you're trying to buy is a big deal. Okay. Investment property, is it a second home? Is it a primary residence? Is it a condo? Is it a co-op? Is it a 2-unit? So all of those things impact the interest rate. So those are really important factors. As a second example, Fannie Mae has something, and you can certainly go out there and Google this. It's called Fannie Mae Loan Level Price Adjustments. I counted them one day, because now we use everything automated, but if you look at the charts, if you Google that, pull the charts, there's literally 170 plus different variables that would go in determining somebody's interest rate. How can I tell you that, hey, you know what you told me about your shortness of breath? Take this medicine and you're all good. How do I quote an interest rate the same way? I need information to properly quote an interest rate.
Mm-hmm.
I need to know what type of loan the client's going to qualify for. Now, the other impact relative to interest rate is the time. So here's an example. You come to me now and you say, hey, Rich, actually, I'll give you a better example. On September 17th of 2024, if you would have asked me what an interest rate was, I would quote an interest rate. And subsequent to that today, December, January 2024, 2025, not even close. The 10-year treasury on September 17th was like 3. Now it's like 462. It's 100 basis points higher. Rates are higher today. Interest rates themselves trade on Wall Street. They change every day. Sometimes they change multiple times a day. So, and that's the other problem with shopping, is because unscrupulous people might give you an interest rate that they don't have to honor because they know you haven't even found a property. So people call me, I could just literally say, hey, rates are in the 6s. Maybe they're not in the 6s. Maybe they're not in the 6s for what the client's trying to do. But I could quote a rate that I'm not committed to because you haven't even found a property. And for the most part, I can't lock an interest rate without an address. There's one little goofy program that allows me to do that, but it's rarely used. But ultimately, I can't lock an interest rate without a property address. And how long do I need to hold the money for? You got a 30-day contract, a 60-day contract? I have no idea. So, again, rate portion, what goes into the interest rate, which will answer your question, what's the borrower's credit score? What are they trying to buy? What type of property? How much money they put down? We didn't even talk about that. What's their down payment? And then we figure out which program, and then we can figure out which rate they qualify for.
Okay. That's actually giving the, how I usually explain it to my clients. And in terms of the program, our previous episode, we did touch on program types. So thank you about that. Now, escrow, right? What is escrow, and what types of escrow are available?
Yeah.
When it to real estate transaction.
Yeah, for sure. We're gonna people to go back to check out that previously awesome episode, because we did talk about one type of escrow, but it's different than the one I thought we'd talk about today. But let's talk about that first. So there is something out there called a repair escrow. And a repair escrow is basically, the lenders determined that some sort of repair needs to be made in order for the lender to have a loan that's saleable to Fannie Mae, Freddie Mac, insured by FA. And so whatever that repair is, let's just say the hot water tank shot. We use that as an example. So if the hot water tank is shot and we know it needs to be replaced, typical hot water tank, I'm just going to use round numbers for now. Let's say it's $1,000 installed. Right. So we'll get a bid from a plumber. Hey, it's $1,000. We, as a repair escrow, typically requires a little bit extra to be put in, like 1.5 times the bid. So we're going to set up an escrow for $1,500, 1.5 times the $1,000. The plumber's going to go out there, make the repair. We're going to cut the check. Plumber gets $1,000, and the extra $500 goes back to the homeowner because it was likely their money anyway. So that's one kind of escrow. But that's not the one most people think about when they hear the word escrow. So when somebody's making a payment, if they're getting a government loan, they are going to be required to have taxes and insurance as part of the mortgage payment. Conventional loan, it's optional under certain circumstances. So what are those circumstances? If you put down less than 20%, Fannie Mae and Freddie Mac prefer to have the taxes and insurance included in an escrow account. Now, when I say prefer, they will allow exceptions for the borrower to pay their own taxes and insurance, even with as little as 3 to 5% down. They'll waive the requirement to have the money put in escrow. But what does an escrow even mean? So let's talk about that. So put in escrow, when you make your mortgage payment, a portion of that payment is going to go into an escrow account, and we're going to pay some bills for you. Which bills are we going to pay? Well, the tax bill. In Illinois, it's going to come twice a year, depending on the county, what month, but it'll come twice a year. That bill's going to come to the mortgage company. When we get the bill, we're writing a check out of the escrow. Same thing for homeowners insurance. Now, all buyers have to prepay the mortgage insurance for the first year they're in the house. This is the perfect month to have this conversation. So we close the month of January. We've prepaid all of 2025. And let's just say for round numbers, the homeowner's insurance is $1,200 a year. When we begin to make our payments, we, the homeowner, our payment, $100 will go into the escrow account. So over the next 12 months, we collect 100. 2026, when the bill comes due, comes to the mortgage company. We've collected 12 times 100 or $1,200. We take the money out of escrow, send the check to your insurance company. That's how an escrow account works as far as that's concerned. Questions about that? Because I have one more very important point to make.
No, I go ahead. The question I have pertain to a personal experience based on adjustment of the escrow calculation. So we can come to that.
Yeah. So clients certainly, hey, if you ever have any escrow questions or there are some adjustments, come see us. What Patrick's referring to is there's always some sort of adjustment because things go up. Insurance is going up, real estate taxes is they're going to have to make adjustments because if they collected in the example we just gave you, 100, the insurance bill is $1,300. Well, guess what? We'll make it a round number. $1,320 is what the insurance went up. So now they're going to write a check to the insurance company for $1,320, but oops, we didn't collect $1,320. We only collected $1,200. So now we have to go back to the homeowner and say, hey, guess what? You can either cut us a check for the extra $120, or we'll just amortize it over the next year. So we have to add an extra $10 to your payment to cover the $120 we were short. But oh, by the way, your insurance is now up $120. So we're not just adding $10, we're adding $20. We're adding the new premium, plus we're catching up for the money we never collected because we didn't know the insurance was going to go up. Neither did you.
Right.
Makes sense?
So it makes perfect sense. And I guess the question I was going to ask about the personal experience, and this is one of the things that I tell buyers who want to buy new construction, because my first home, I bought a new construction home, right? And as we all know, we pay taxes from the previous year, not the current year, right? So depending on which month they build the house, the taxes that they will quote you is going to be taxes for the land, not taxes for the land and the house. So to your point, if you put in a 1 year, the entire taxes for the year, you are going to be short the previous year, right? So then all of a sudden with the adjustment, you could end up with, a payment, which, yes, by law, they are supposed to disclose it to you when you are closing on the house, right? From my personal experience, it's like, yeah, they try, but how many people are going to save that extra money to catch up? And even how much should they be paying? So in terms of the adjustment, it becomes a shock to most new because they didn't go in with that mindset or thought. And on top of that, and I one of the things that I am trying to avoid is to talk about other mortgage companies, because from what I've also come to notice, especially buying new construction homes, is they will convince you to go with their in-house mortgage companies.
Yeah.
And they talk about all the fees, all the credits and programs that they have, but they don't tell you that you're also going to pay for the cost of the street in front of your house and in that community, right? So let's put that.
There's a lot to unpack in that statement, my friend.
Right. And I think that can be a whole different episode. But thank you for actually answering that question before I even asked it in terms of the adjustment, because it's not just for the insurance, but also for mortgage payments. Because when there's a shortage, to your point, there needs to be an adjustment. And either you cut a check or your payment is going to go up. So you need to be ready. I guess this would be a great segue to the next topic that I want to talk about. How about the individuals that want to pay off their homes early? Finish. That's two. We did talk about PMI. Recently a question from a colleague of mine who wanted to know how can they remove their PMI. But I guess at the end of the day, it boils down to how much equity they have in the house based on the fact that their principal is lower than what the projection was supposed to be. So let me make this concise. I want to remove my PMI, or I want to pay off my mortgage. With the different mortgage types, one, what are some of the disadvantages or penalties involved in doing that?
Okay. So let's answer the PMI question first.
Okay.
So there's really two ways to remove the PMI. Now, obviously, you pay the mortgage off, you're not going to have PMI. So we'll get into the mortgage. That's a whole different concept. So PMI in itself.
Okay.
If it is truly PMI, that's the first thing. So if you have an FHA loan, you're not getting rid of your PMI. It's there. It's not going in. Excuse me. The only way to get rid of it is refinance it out of FHA.
Okay.
It's not anywhere. So that's the first thing. So if it's truly PMI, which is going to be Fannie Mae, Freddie Mac, truly PMI, we're going to give you two examples here. Let's say, and these are round numbers. I know they don't make sense in our market, but it's just easier for the math. If you bought the house for $100,000 and you put 10% down, you're going to have PMI. Now, having PMI, let's say there's two ways to get rid of it in that situation. One, pay the balance down over time or in some sort of lump sum, pay the balance down to $80,000.
Okay.
Pay the balance down to $80,000. You go back to your lender and say, hey, look, based on what I appraised the house, what I paid for the house, and you, lender, have that appraisal based on what I paid for the house, I'm no longer at a higher than 80% loan to value equity position. I would like you to remove my PMI. And typically they will just do that because the balance is now 80% of what the original purchase price. That's one way to do it. Another way to do it is, let's say we did that scenario, $100,000 purchase, and we put down 10%. Now, a year from now, we went on and put on, let's say we added a 2-car garage. And we just financed that with our own money. But now that house is worth $120,000. We didn't really prepay the mortgage much. Maybe we still owe 88 or something, whatever. But we made improvements and the house appreciated over the year. It's now worth 120. So if we owe 88 and the house is worth 120, we're definitely under 80% loan to value. Again, call the mortgage company and say, hey, I would like to have my PMI removed based on today's value of the property. They are going to say, okay, great, Patrick, the name and number of an appraiser, contact them, pay them direct, set up the appointment. They'll send us the appraisal, and we'll get back to you and let you know when we're going to drop it. Those are the two ways to drop it. Of course, besides paying it off, which would be number 3, but that's an easy one. You're just going to pay it off. Let's talk about paying off the mortgage, because I think that's an important conversation. You have, this, forget the term for it, but these people that won't sell their properties because they've got a 2.8%, a 3.2% mortgage interest rate, which is pretty darn good. Those are pretty good rates. So especially if you could take that money and invest it, and that's what we're going to start talking about. Is it right to pay off the mortgage? So if you could have taken that money and invested it in the S&P 500, last year you would have made, don't hold me to the specific, but it's somewhere around 24%, 22, 25, whatever it is. So where would rather take that? Let's just say it's $100,000 mortgage. I pay off $100,000 mortgage. Let's say I'm trying to get rid of a 7% interest rate. I took a 7% interest rate. I sent them $100,000. I saved $7,000 this year. But if I had taken that same $100,000 and invested it in the S&P, I would have made 24%. Now, now, granted, I'm still paying 7% on my house, but I made 24%. If I do the math, I still made 17% on my money. I
Right.
would much rather have my money in a place where it can earn money and not pay off the house. Now, that
Okay.
being said, does the S&P always make money? Nope,
No.
absolutely not. So I went back and did analysis for like the last 4 years with the S&P. The S&P actually lost 18% about 3 years ago. 18% for the year. So it might have been the pandemic year, but it still lost 18%.
Right.
But if every year around it, it was in the 20s. So I took an investment. I think I did this over a 4-year or 5-year period. In the return was like 66%, even at losing 18%. So I had $100,000 investment. At the end of 4 or 5 years, it was $166,000. Here's the other issue with paying off the house, and this is the one that concerns me too. So you pay off the house, you've got a $400,000 house, and there's no balance. Okay. That $400,000 house is appreciating whether you owe money on it or not. It's going to appreciate and make money. It doesn't know, the appreciation doesn't know that it's free and clear. But if you, the homeowner, have a financial crisis and now you need money and you have this $400,000 asset, it may be very difficult to go get a mortgage on that asset if you're in financial distress. You lose your job. Oh crap, I don't have a job. I might need some extra money to support my family while I'm looking for a new job. Oh, something happened to us, maybe a health, God forbid, something happened. I need some extra money there. I now have this $400,000 asset that now the bank looks at me unemployed, or maybe I'm in the middle of a divorce and my spouse we've got credit stress because of it. And now I need to go get money. You're not going to be able to get money. So my recommendation there is, at least at minimum, have a line of credit on the house so that you at least have access to some of that money that's there. Typical line of credit with the bank, if you don't use it, they're going to charge you like $50 a year. Who cares? It's a nice insurance policy to get access to your equity if you ever need it. So got one on my house. So it's a big deal. So, yeah.
Thank you so much, Rich. Time. I do have more questions about paying off mortgages and stuff.
Go ahead and ask. We got a little time. Go ahead and ask. What do you got?
Okay. So how can someone? What are the ways that people can pay down on their mortgages gradually? So, because from my understanding, let's say, for instance, a 30-year fixed, usually the first 7 to 10 years, that individual is going to be paying most of the interest rate. Most of the money is going to go towards the interest rate, from my understanding, right? Based on the calculation.
Well, most mortgages in the United States are what they call simple interest loans. So you pay, yes, you pay up front, but that's just because you owe more up front.
Right.
It's not as if you're required to pay a bunch of money up front because the lender's locking that in. That used to be some old lending rules. But simple interest loans, of course, you'll pay up front. To answer your question where I think you're going, if somebody wanted to knock off 7 years on the back end of their mortgage, all they would literally have to do is make one extra payment a year. And you knock off 7 years off the back end of the mortgage. So if your mortgage payment was $1,200, send in an extra $100 a month. That's the equivalent of one extra payment a year. And you save at that point 7 years. If you think about that, the 7 years is 84 payments. And in the example we just gave you, 84 times 1,200, that's a lot of money.
Right. As an investor, so these are things I think about, because I also have investor clients, and some of them are not comfortable having such responsibilities. Like, I can't see myself making mortgage payments for that long period of time. So, these are questions that I have. Now, going back to the loan terms, right? I know for fixed rate, usually there isn't a penalty if you your loan early compared to the other loan terms, right? Can you touch on that a little bit for us?
Typically, the only that you're going to see a prepayment penalty is on a commercial loan.
Okay.
Residentially, for the most part, they're not really permitted.
Okay.
Commercial, that's they're going to lead with some sort of prepayment penalty packed into
Okay.
the terms. Now, there are residential loans, typically on investment property, or when we started talking about non-agency loans. So loans that don't get sold to Fannie, Freddie, and Jenny, non-traditional loans, some of those will have a prepayment penalty. So it is important.
So usually with such loans, how long is the individual supposed to owe them before paying it off to prevent such penalties?
Yeah, on the residential, you could see 1 to 5 years on penalties.
Okay.
Really just
Okay.
depends. And a lot of times you can negotiate with the loan officer and say, hey, you know what? My intent is to sell this thing in 3 years. Cool. Just get a 3-year prepayment penalty. It'll be over and you can sell it in 3 years. All of that
Okay.
stuff is negotiable. Typically a prepayment penalty, if you have it, it'll just reduce your rate. If you want to waive it, your rate goes up.
Okay. So much, Rich. I really appreciate this, your time and this 2 episodes, because I've learned a lot, and I always learn a lot when I talk to. I do appreciate all your time, your knowledge, and the willingness to with us. If someone wants to reach out to you and your team, how can they get a hold of you?
Yeah, one thing, somebody wants to reach out to us. This is something we offer to all of our customers, and I'm going to extend it to your listeners, Patrick. We do a mortgage statement analysis for our clients once a year. They provide us their current mortgage statement, and we look at it to make sure, A, are they paying PMI when they shouldn't? B, are their escrows properly collecting what they should be collecting based on the bills? So if you're interested in that or have any other questions about mortgages, call me and my team at 847-603-2300. It's also the Rich Kimball team.com.
Thank you so much, Rich. As always, really appreciate you. And hopefully we get to see you again in the near future. Thank you.
My pleasure. Thank you, Patrick.
Yeah.
All right, buddy. I appreciate that. You have